Hey, it's Paul Canner. Welcome to Mortgage Basics. Hey, I bet this picture got your attention. This could be a house that someone purchased 8 months ago and never made a mortgage payment. And it went into foreclosure and they just got pissed. And look what it looks like. Today, we're going to talk about PMI and how we can get buyers into a house without large down payments. You ask folks how much money you need down to buy a house. A lot of them will tell you 20%. A matter of fact, I think I asked the other day, someone told me 30% down. Well, guess what? Today's world, we have mortgages that allow some with 0% down, some with 3% down, 3.5% down, 5% down, 10% down. But what if this happens? What happens to the lender? 8 months in, granted, property values are going up. What's it going to cost to repair this thing, get or sell it at a loss, and pay the realtor? House has lost value. What are we going to do? Well, this is where we come in with PMI or private mortgage insurance. Now, PMI is kind of a generic term that we use. It's actually a brand name, although the PMI company is no longer. FHA loans, which are government issued, do have mortgage insurance. People typically refer to it as PMI, but it's not private. It's provided by HUD, so it's just mortgage insurance. So what happens here in this particular case, it was a $200,000 home. Now, these are hard to find right now. Person put 10% down, $180,000 loan, but the lender wanted coverage in case, you know what, this happens, that they can be whole if they've got to make up the money of the lost payments, repairs, selling expenses, so forth. So the mortgage insurance carrier, PMI company, is going to cover $45,000 extra dollars to make repairs to the house. So how does PMI work? Well, what happens on conventional loans and jumbo loans, it's priced on credit worthiness. So the higher the credit score, the lower debt to income ratio, the lower the loan to value. Remember that Mortgage Basics? I think it was one of the first ones I did. The lower the cost of the PMI. So somebody with a very low credit score, let's say 660, that is considered low. In other words, their PMI is going to be a lot more expensive than somebody with a 760 FICO score or credit score. Now, this is what sometimes when we'll look at doing what we call FHA loans or HUD loans, which require 3.5% down payment because they charge the same PMI rate regardless of the credit score. Now, the pricing of the loan will vary a little bit. The interest rate closing costs may vary a little bit by the down payment, but the PMI allows somebody to buy the house without putting 20% down payment, because with 20% down, typically lenders will always be made whole. Now, you can pay this on a monthly basis. We can hide it and have a no PMI loan. But what's happening there is somebody like me, I'm going to go to the PMI company and say, hey, PMI company, will you sell me, insurance company, will you sell me a policy in a lump sum to the lender so I don't have to worry about consumer things? And they'll say yes, and they'll charge me maybe 2% of the loan amount or 3% of the loan amount, depending upon the variables. And so I'll build that into the rate, the return I'm going to get over time, so the consumer takes a higher rate. Now, this typically will provide a lower monthly payment up front, but as we all know, homes are appreciating quickly, and in most cases, when someone's paying PMI, this is not mortgage insurance on FHA loan, but PMI, we're going to be able to have it removed through the house appreciating within about 2 years. So anyway, PMI, private mortgage insurance, it's a 3-letter word. It's not a 4-letter word like bank, allows you to buy a house with less than 20% down. Sometimes we'll refinance folks just to get rid of the PMI because on FHA loans, it does not come off. So now you know PMI allows folks to buy a house with a small or no down payment.